I'll kick it off by introducing myself. So Jeff Stoss, I have over 20 years of experience in CFO and senior strategic finance roles. So after growing up in accounting firms, I've had the chance to launch into industry and work for everything from startups to venture capital backed companies, private equity backed companies, and public companies, primarily in the technology and services industries. That includes spending over 6 years with Cognos, that was later acquired by IBM for $5 billion, working in mergers and acquisitions, and even building a finance shared service center over in Amsterdam. I co-founded what was initially a fractional CFO outsource firm in 2015 called Positive Venture Group, and that later merged into Consero in July 2021. So that brings me to where I work with Consero today as both a client CFO for a number of our Consero clients, as well as I oversee Consero CFO services offering.
And I am Trey Swain, and similar to Jeff, my first CFO position in a pre-revenue startup was in 1999. So I've spent a little over 20 years before I joined Consero in various early to mid-stage growth companies that were either VC or PE-backed entities. Throughout that time, went through many M&A transactions, many equity and debt raises, and so have all the scars to show for those transactions, and ultimately decided to join Consero toward the end of my career and joined the CFO services tower and started helping Consero clients primarily on transaction support with M&A deals and debt and equity raises. Most of my experience has been in the SaaS world, as you might expect, having been with so many VC and PE-backed companies. And so my role at Consero is also twofold in that I run a portfolio of our SaaS clients in our F&A outsourcing side of the business, and also step in and provide CFO support services to our clients.
Great. So to kick off our discussion today, we're going to first look at some interesting metrics on the role of the CFO. And it's a good opportunity to think about the specific opportunity that this leads to for fractional or interim CFOs. So economic dynamics over the last number of years, including throwing in a pandemic, have led to a 5-year high in CFO turnover. So tenure for CFO is well below the average for peers like the CTO or CMO, that both average over 4.6 years tenure, whereas a CFO is closer to 3.5 years. So following some of the wilder financings and valuations in 2021, all companies have been asked to focus on extending cash runway and growing profitably, making the strategic work that CFOs do more valuable in recent years to their companies. Optimizing the order to cash process, for example, might be your way to avoid or reduce or delay staffing actions. Demand for fractional CFOs has grown for a variety of reasons, including the general awareness of the availability of this short-term on-demand expertise. And after the pandemic, some companies are fully back in an office, while some remain remote or leverage a hybrid approach. But over the last number of years, companies have become used to working remotely and leveraging the services of a remote fractional CFO. And talent shortages and turnover make a fractional CFO a great option while companies search for the right full-time CFO. And even when they have found that perfect full-time CFO, you always have to watch that first starting date pretty carefully, because we've actually been brought in over the last number of years when somebody turned away at the last minute or announced on their first day of joining that they found a better opportunity. So having engaged a fractional CFO in the lead up to that first day sometimes is a way to mitigate this sort of risk. And over to Trey for the next slide.
What are the benefits of having a fractional CFO? Clearly, the best benefit is mostly economical, and the flexibility and the ability to accelerate bringing a CFO perspective into an earlier stage business is a primary use of a fractional CFO. The ability to have kind of construct a deal that the company can afford financially, but just gets, whether it's a few hours a week or up to 50 or more than half time, the fact that you bring in a more experienced financial mind to kind of look at the trends of the market and look at kind of where the company is in its growth phase and bring that perspective to the table at the management team meetings or in supporting a specific transaction or a strategic initiative. That is clearly a big benefit of a fractional CFO. So if it's not accelerating the CFO perspective into an earlier stage business, it's generally around quickly filling a gap that is existent either through the transition of the existing CFO or financial leadership in the corporation, or a strategic initiative where the residing CFO and or accounting team doesn't have the requisite experience, like an M&A transaction or raising debt or equity. Those would be the key benefits, and just the economics of bringing in someone who's fractional, who can be replaced with a permanent CFO if that becomes the right decision for the company. It's just an easy way to facilitate that process.
So we're going to walk you through how the needs for CFO services kind of change as a business grows, and I'm going to kick it off with talking to you about both seed and Series A stage. So seed funding is generally the first official equity funding stage, often sourced from founders, friends and family, and angel investors. There are some VCs that specialize in investing at the seed stage with the intent of following on through the Series A. Typical raises here are $1 million to $3 million. During seed funding, it's about selling the vision and the potential for a startup. Seed funding finances the initial development of a product or service and market testing and building a founding team. CFOs at this stage help companies set up their initial systems and controls. They're taking care of compliance and building out the initial reporting and KPIs that'll be used to measure and manage the business. Often basic cloud-based systems like QuickBooks and Xero will suffice at this stage. To keep their budgets in check, companies may also start to benefit from outsourced or fractional service arrangements like payroll, IT, HR, or earlier stage finance as a service offerings. In early 2020, I had the opportunity to help a spin-out company raise their initial seed round that it needed by navigating through a variety of angel groups with their wide range in preferences for deal terms. Helping get these varying perspectives aligned around a common set of financing deal terms is one of the ways the CFO supports seed rounds. This round relies heavily on the entrepreneur selling their vision. There's usually little in the way of business metrics or proven traction at this stage. Investors are generally betting on the idea and the team. The CFO's role is to help the founder team understand and navigate through the fundraising process, which may be unfamiliar ground for them, and to make sure the business metrics and a business model effectively tells the entrepreneur's story in financial terms. You'll help the company develop a winning pitch deck that explains the opportunity for investors. You'll help the company build a pipeline of investors that might participate in the raise. You'll spend time helping the company and investors find the right set of financing terms for the round. And you're also making sure that they avoid surprises in the lighter due diligence that goes on at this stage. So fractional CFO is a perfect fit for companies at this stage, as the CFO work is not full-time. The companies do not have to skimp, though, on experience that they need to support fundraising efforts, and they don't have to break their budgets in doing so. For companies that survive this far, the first round at the seed stage is Series A funding, and typical raises are 8 to 15 million. Typically, this will include a company's first VC on its cap table. Investors are not looking for just great ideas at Series A. They're looking for great ideas with a strong strategy for turning that idea into a successful, profitable business. So Series A funding can be used to optimize the product, user base, and the business model. I've seen these funds used to build out enterprise-level customer requirements or to experiment with the various go-to-market strategies that might form the basis of a potential future Series B financing. CFOs at this stage must help develop a business model that shows the company will generate long-term profit. They'll also help research and source potential funders to the round. As the company has more history and traction, there will be a more robust set of DD expectations. They should also help the company upgrade its financial reporting and modeling for the more sophisticated investor audience they will soon have. The CFO helps the company effectively dress for the job that it wants. They can also help the company understand how their world will change following the raise, where they're going to need to upgrade their processes, systems, board and investor governance, and reporting cadence. The metrics entering into this round versus a seed likely dictate whether the outcome will be good or great from a funds raised or a pre-money valuation perspective. I had the opportunity to help a client prepare for and close its Series A in 2021. A larger new VC led the round and engaged a Big Four accounting firm to conduct elements of its due diligence process. Having the experience gained from working in accounting firms or alongside them in enough deals allows the CFO to speak their same language to facilitate an efficient due diligence experience. So knowing what is expected at this phase de-risks the fundraising process. The lead up and execution of the Series A is also a time to help companies think through compensation strategies and actions, hiring plans, stock options and cap table cleanup, tax planning objectives, and even opportunities for founders to get some chips off the table through secondaries. It's also useful to think of the equity raise element of the Series A as just part of a larger funding program. Ironically, when companies will have the most money they've ever had in their accounts following the equity close, it's also the best time to be considering upgrading their credit facilities or closing a complementary venture debt raise. You'll help companies invest their surplus cash if that's not already dictated by their funding partners. And in some industries or geographies, the raise can also be used to unlock various non-dilutive funding grants. So we were introduced to help an account recently that had learned a tough lesson when their former CFO only commenced a debt financing outreach well after 6 months following its equity raise. Universally, the feedback they heard is that the deal terms and process would have been more favorable if they had just engaged earlier, hence why this client was looking for a new CFO. We believe strongly that a fractional CFO can help lead a company through a Series A. The same can be true through Series B, but it will depend in large part on the bias or preference of the board or the lead investor following the Series A raise. They may want a full-time CFO for the road that follows, or there may be a full-time role post-Series A if the CFO is happy to play a dual role in operations. So for fractional CFOs, sometimes our thanks for a successful outcome, where we really prove the value of a CFO through the raise, is that we work our way out of a job. Of course, we take with us more marketable experience, relationships, and maybe a bit of extra comp in our pockets for our efforts. So the value of the CFO will rise for their future clients with each transaction they close and from the relationships they build along the way.
So as I'm sure everyone is aware, the game changes at each one of these phases. So getting into Series A, you're pitching to investors who are saying, how big is the problem you're addressing and how well are you going to be able to address it? That is their primary question. And of course, as you get into Series B, those questions should be answered. And a lot of the questioning from the potential investors come in as where do you fit in the overall landscape of solving this problem? And how well have you established your foundation for growth? And so start change when you get from the Series A to Series B, that not only does your story need to change, but the nuances of who you're speaking to and what the Series B investors are looking for changes. And so as you might expect, as we go through this presentation, one of the key emphasis is that hiring a fractional CFO, you need to be very, very mindful of what of these phases your business is in, because having extensive experience in any one or two of these phases doesn't necessarily prepare you as a consulting CFO to be as effective in other phases of the business. The needs just change over time, and the experience that you gain in early stage businesses don't always translate into the growth and beyond stage of the business. I, for one, have been through several recruiting discussions where the ultimate outcome is, well, your resume is great for early and growth stage, but we need a CFO that's been, run a $500 million bigger company from a finance perspective. And not only would I probably be pleased that they didn't think my resume was a good fit, I wouldn't be happy in that role. And so it's just, it does help not just from having the right fit culturally and mindset, but it's certainly when you bring in a fractional CFO to solve a specific problem, the solution that you would bring to the table will change as these stages change, because you're speaking to a different audience and you're meeting different challenges in growing the company. And so the evolution that takes place from Series A to Series B is how well are you set to manage your economies of scale? Are your margins going to continually increase? What do your unit economics look like in your business? Those things are extremely important going into a Series B raise. And so when you think about it that way, it may be that it's a time to overhaul the KPIs that you're using to measure the business. It's less about customer cost of customer acquisition than it is about the lifetime value of those clients, as an example. And so there's always a changing mindset. And as a fractional CFO, you need to be aware of that. And as someone who's considering hiring a fractional CFO, we feel it's really important that you look at the experience that that particular resource has in managing through each of these phases of the business. And so at the end of the day, you definitely want to be very cognizant of that and know that it's a different set of problems that you need to solve. And it may be that you need to either augment internal skill sets and experience to get over that hump, or you need to bring in someone that's has that experience to augment those skill sets as you migrate through Series B and beyond. In Series C, I think it's really more of the same. It's except bigger and more extensive from that standpoint. Fractional CFOs that come in at this stage and beyond are generally more of a point solution. We need to evaluate this divestiture, or we're looking at a couple of M&A targets and we need transaction support there. It could be that you're thinking about exit strategies and you need to support the exit strategy and work with investment bankers and such on that front, be a liaison to the management team and the investment bankers, that unbiased perspective. And so when fractional CFOs are considered at this stage of the business, it's generally less about building the right foundation that you would need to build in the Series A and pre-Series A timeframe, and much more about efficiency, economies of scale, cash flow management, and what potential expansion strategies are there, be it international or new product lines. Those are all opportunities for a fractional CFO resource to step in and make a huge difference in making the right decisions as to the next phase of growth of the company.
Yeah, so when does hiring a fractional CFO make sense? So often the companies we meet in some of those earlier stages, they might have a very solid director of finance, VP finance, controller like lead that's overseeing the basic blocking and tackling of the finance operation, but maybe just has a little bit less experience when it comes to strategic transactions or fundraising strategy. And the work level for that requirement for senior experience is just frankly not a full-time job yet. So it's a perfect opportunity for a fractional CFO to come in and complement the existing team. Quite often, and not all fractional CFOs are comfortable with equity raises. Some are more experienced in debt refinancings and supporting private equity companies, and some are more familiar with working in larger public companies. But being brought in with that specific experience is a great opportunity for fractional CFOs to come in and help support a transaction, and then the needs might grow to maintaining that CFO after a raise is made. But probably in the last number of years, where I've seen the outreach more often is just as a result of the economic environment we've been operating in. We went from the highs of 2021 with very, very large size rounds and high valuations, that was then followed by the world coming back down to earth. All of a sudden, we were dealing with higher inflation. There were some bumps in the roads with venture debt lenders. And all of a sudden, people wanted us to make money again. It wasn't just burn money for growth. We had to figure out how to be profitable and extend our cash runway to 12 months, to 18 months, to 24 months. So all of that requires somebody that's got the capabilities to model multiple potential paths to extend cash runway in a very strategic way. Also, if a full-time CFO is not yet in place and a company is entering into a financing round or potential exit, they can get the right level of experience they need to execute the transaction from the CFO. But with a CFO that operates under a contracting model, that might lend itself very well to the type of transaction, because sometimes those services, can be wound down pretty easily if the role shifts to a full-time role after the transaction or disappears as a result of the transaction, like after an exit. So fractional CFOs can also be brought in to help full-time CFOs move initiatives forward that there's never enough time in the day to get to, but that cannot be delegated to a less senior resource. So we've helped in a number of instances following private equity exits or changes in private equity investors, where the sitting CFO just frankly needs some help moving some initiatives forward that a contractor CFO is well suited to manage.
Okay, so won't need to spend much time on this, but what this slide tells you is why the demand for fractional CFOs is so high right now and has been growing over the past few years. Compensation for CFOs, even in low cost of living areas and in earlier stage companies, is going up, just like all salaries are. And so it just has become a bigger imperative for companies to find the expertise without having to make this type of financial commitment. Now, what that does mean for everyone who's considering leveraging a fractional CFO is that this increased demand has increased the supply. And so the supply of fractional CFOs out there has grown steadily to meet this demand. And that means there are more and more unqualified candidates out there that need to be properly vetted. And so we'll talk further about what we feel like you need to do to fully vet that resource. So at the end of the day, I mean, when you have this increased demand and you have a lot of supply out there, and there are people that are new entries and they're taking advantage of the fact that there is this demand, and it's almost hard to find fractional CFOs most of the time. It still is very important that these candidates are properly vetted. And I would say that the best way to do that is to vet it through reference work, and whether it's references that are provided or references that you find through their prior work. If you're considering hiring a fractional CFO to support a transaction, talk to others like bankers and investment bankers if it's M&A, or bankers if it's a debt deal, or investors, PE investors if it's to support an equity raise. It's just very important that you get the vetting done properly so that you come out and so that you get that right resource in there that has those qualifications. Bringing in someone who doesn't have those qualifications, that may take time to vet that out and to get that out of the business, and there could be damage done in the process. So you just want to be really careful. The good news is, obviously, you wouldn't necessarily need to be as careful as if you were hiring a permanent CFO, because the contract should be somewhat flexible. And to that end, I would say that if a potential CFO is very deliberate about having a long-term contract that's committed, then it's something that I would look at with a little bit of wariness, because their value should be very evident on a day-to-day basis. It's almost like, I'm really happy you're here. These are perspectives that we wouldn't have been able to get otherwise. We can feel your experience. You may or may not get that feedback directly, but that should be something that is kind of operating in the operating relationship and partnership that you have with the client, CFO, and management team. But at the end of the day, it's just super important to get that right person in there. It's super important to cut the losses if you're not feeling that value come very quickly. Again, a fractional CFO should not have to come in and take 30 or 60 days to fully understand the business model and to understand the financial dynamics. If they have the experience that is on their resume, and they've been through all of those types of transactions and worked in the right phase of the business, then they should be able to add value almost from day one. And so if weeks are going by and you still feel like there's an orientation that's going on, or you're not feeling the value come back at you in a very obvious way, then I think you should pretty quickly evaluate whether you have the right candidate. And so that's what's most important about getting the right person in.
So some tips for benefiting the most from this partnership. As Tracy said, that the relationship between a client and the fractional CFO starts with making sure that that CFO is the right technical and industry experience that addresses the client's needs. But more importantly, this also comes down to the personality and cultural fit as well. The relationship with the CEO is vital, but it's also very important to focus on some of the other key relationships for the CFO with the rest of the management team. Often that's working with the chief revenue officer, maybe it's the head of people, or maybe it's the managers with the largest teams. It's always very important to make sure that the relationship is strong there as well. And how do we set clear goals and expectations? I mean, prior to signing, the CFO will have a great sense of the company's priorities, where the CEO is going to outline their expectations around the goals for the CFO. But it's still important for the CFO to conduct a situation assessment while onboarding after they've signed by reviewing some foundational materials of the company to identify whether the company needs to be thinking about other priorities that they may not have been aware of. Especially with more of this work being remote, full-time, or part-time, communication is paramount importance. So establishing a meeting cadence with the CEO and leadership team, and establishing recurring meetings to discuss vital topics like a weekly cash flow management or month-end financial results and KPI reporting or quarterly business model updates. Even if you're fractional for 1 day per week, you as CFO still need to be available 7 days per week when it matters for the CEO. And if you have multiple clients, having a communication escalation path for each of them, consisting of emails, text, Zoom, or Slack channels, is important. Even if it's just to acknowledge that you understand the request and can provide an estimate of when you're going to get back to them. One thing I've greatly benefited from, if you're fortunate enough to have leverage and support of either a strong VP of finance or controller that sits atop the accounting and finance operations, or a strong FP&A leader alongside you, you're going to be able to stretch yourself further by having those senior resources be able to interact directly with your clients as well on your behalf and respond faster as a team. It also lets the CFO focus more on strategic finance work. And then you would often use that recurring meeting cadence to constantly gather input on what's working and what could be working better, and to quickly identify new priorities based on changes in the business. It's a vital feedback loop in the overall scheme of things. And in the early days of my contract CFO work, when it comes to what technology can be leveraged, I used to have a lot of time wasted switching between clients when they had varying on-premise accounting software packages and unique charts of accounts and flux capacitor spreadsheets holding up the finance function. So thankfully, we have several high-quality cloud-based accounting software packages available with easy third-party integrations for expense reporting and time and attendance and AP workflows. And with the growth and quality of finance outsourced services that are able to integrate world-class ERPs into their offerings, clients can now onboard to these larger scale solutions more cost effectively and earlier than they ever would have thought of engaging for these services directly by doing so through a finance outsource firm. And then they can focus on getting onto a system and set of processes that can scale with them for their future, and they don't have to worry about switching all these systems every time they complete the next raise. And also, I guess, in terms of just overall supporting the work we do as CFOs, we leverage nice tools like PitchBook or Crunchbase to help identify funders and to research deal terms and M&A transactions to help guide our clients.
All right, so the key takeaways here. The first one I think you can't really underemphasize, and that is that you need to find a resource that has specific experience in the stage of the growth stage of the business. I can't emphasize that enough. The needs of the business are somewhat shaped by the phase of growth that they're in, and the audience that you are working for and working with is very different in each of those growth stages. And so if it were me and I were evaluating a resource, I would probably rank what I was looking for in this order. First and foremost, do they have the skills and experience with the specific challenges that we're facing in solving those problems? Number two, have they worked in this phase of growth? And I would rank that even higher than do they have specific industry experience. I think it's very important, and in some industries it's more important, to have that industry or vertical expertise. But in my mind, a good, smart fractional CFO can learn a business model very quickly. And just knowing the nuances of the phase of growth of the business is even more important. Obviously, at the end of the day, you want to have someone who can communicate well, and you would have no problem having to speak to your investors or to your bankers or to potential investors. And so that obviously is part of the overall package that's super important as well. We've talked extensively about how hiring fractional CFOs provides the maximum cost effectiveness, both from the standpoint of not having to pay that full-time salary and generally, in most cases, give up any equity. But then also with the flexibility, if you hire a permanent CFO or the transaction or specific initiative that you hired the fractional support for is no longer required, then you can cut those costs out at any point in time, usually. And then again, as I've said many times throughout this, it's critical that you find the right person or resource, and then obviously being willing to move pretty quickly if you don't feel that value coming back to you in very short order. That the primary benefit of a fractional CFO is you bring in someone who is going to hit the ground running and have skills and experience that can elevate the business on day one. So you really shouldn't have to wait 3 or 4 weeks for them to really get in and start creating value. But getting that right person in there and understanding what you're looking for and way to measure it, just like you would a permanent CFO, is important to think about.
Thank you so much, Jeff and Trey. This has been really great. We had a couple questions come in from the audience. So the first one, are there times where permanent CFOs engage with contract CFOs for support? Jeff, I think this might be a good one for you to take on first.
Yeah, we've seen this quite a bit, actually. So like in the world of private equity, like sometimes you've got this, the change in private equity owners, and there's frankly this box job of they need to move they need to migrate from one ERP to another. They've got maybe they've got new investors at the top, and they've got to change their whole org structure, and they've got to wind down various legal entities and set up new ones and new transfer pricing agreements, all of which would probably bore that full-time CFO to near death, and they would be preferring to spend their time doing more strategic or client facing or working with the rest of the leadership team on new initiatives. But frankly, they just can't delegate that to their controller to just do that, because they haven't been there and done that, and they might not even speak the same language as some of their tax advisors or valuation experts they need to speak to quarterback some of those initiatives. So often we have been engaged in those types of cycles. The other sorts of opportunities where we've come in to kind of help out is, frankly, they're just staring at, if they could get to it, they've got a financial close they need to squeeze down from 20 days to 7. They've got a DSO problem where they got to bring it down from 75 days to 35 days. And somebody that can kind of speak with all the various different parties and understand how the different pieces work to kind of optimize those processes. A contractor CFO could be a great solution to come in and take on some of that project work and move some of those files forward where they focus on the things that they would like to prioritize with their time.
Great. Yeah, those are some good points on how CFO support can come and assist. And the next question, what is the typical engagement length for fractional CFO services? And is there flexibility in the duration of the engagement? Trey, if you want to take this one on first, I'm curious to get your thoughts on that.
Sure. Well, I think the short answer is there is really no typical engagement length. I would say if you're thinking about hiring a fractional CFO to support a specific transactional M&A, debt, exit, those are all things that have a beginning and an end generally. If it's for general support and it's to bring in kind of the earlier accelerate bringing the CFO level resource into the business, those contracts can be structured, I would say, on a 6-month retainer type basis, and that can be reevaluated at any point in time. I think at the end of the day, you don't want to sign up for a long-term commitment necessarily longer than what you might think you need. And if the CFO resource is asking you to do that, obviously there may be cost savings or such if you sign a retainer versus pay on an hourly basis, but locking into a long-term deal should not be necessary. But and that ultimate flexibility in my mind is more important than the length of the engagement. You should be able to move pretty quickly to go in a different direction if so desired.
Yeah, and some of those earlier fractional, especially in that seed to Series A, we've definitely had some experience where just because of the time between fundraising rounds or when the work eventually creeps up to being full time, some of those engagements can go for 2 to 3 years. We've even had like one of our clients with us 7 years because they found a way to divest of an old business unit, and lo and behold, the startup that was going to retain with the ownership structure afterwards as well lent itself very well to a fractional CFO model, but still making the contracts very easy to work with, such that either party can effectively come, bring the relationship to an end if in fact the needs change and it's no longer a fit for us to be working together.
Great, thank you both. And then the next question, what tools and technology do you use to provide financial insights and support remotely? Jeff, did you want to talk on this one first?
Yeah, I mean, I think we've got like some great, I frankly love the world of working in the larger ERPs. If there's a cost-effective model to get to working with them, whether that's a Sage Intacct or a NetSuite, like something that's a little bit beyond just a basic GL, where you can get into the dimensionality of your business, something that integrates nicely so you can not spend your time having to do a bunch of manual processes, and you can build out some nice integrations that make your organization work efficiently. But also, once you do some of these raises, your cap table becomes a bit of a beast to manage. So, there's great tools out there like Carta and others that can handle, whether it's managing the cap table, it's managing exercises, it's managing some nerdy stock-based comp accounting that some auditors are looking for. Those can be great tools as well. And we're on the cutting edge of looking at, how AI as well will be changing some of these areas, whether it's like AR and AP automation. And certainly I've seen some of my colleagues that work with public companies thinking about how they can best leverage this to write these seemingly endless MD&A documents and other materials that you need for public companies. So should be interesting years ahead in that regard.
Yeah, definitely should be interesting to see what comes of AI and the advancements. So that brings us to our next question. What is the process for onboarding and getting started with fractional CFO services? So everyone wants to take that one.
I can give that one a shot. I think I spoke to earlier, a fractional CFO should not necessarily take much time to get started. I mean, if you feel it's taking longer than it should, then that's a key early sign to be aware of. Certainly getting oriented on the business model, getting introduced to all the key players, it should not take more than a week or so of getting everyone introduced and up to speed. And again, a fractional CFO, we're not hiring a new grad. We're bringing in someone who should have been, have the scars of all of the types of things that you see out there in the marketplace and what a CFO generally handles. And so it should not be unfamiliar territory for a fractional CFO to step in and be expected to start adding value very soon. That said, the more that you can give preparation and think ahead as to what will be the key things they'll need to know about the business model, about key relationships, about the culture of the company, the employees, and how the employees are communicated with. I think the more that you can get a fractional CFO immersed in those types of things, the more they'll be able to fit into the organization quickly and start to be a good cultural fit. And depending upon their role, and be someone that is a valued resource for people in the organization across the management team and even at the next layer of management. And so that it will vary depending upon the type of work that needs to be done. But I think the short answer is a good fractional CFO is going to be very quick on the uptake and should not take an extended period of time to get fully oriented.
And that brings us to our last question. How do you ensure confidentiality and data security when working with sensitive financial information? So whoever wants to try that one out, maybe Jeff.
Sure, yeah, I could take the first crack at it, but I mean, ideally, you've got to understand your clients' IT protocols, like especially in SaaS space, you got a lot of clients that are known for SOC 2, certification. So like making sure that you're following all of their very specific rules. You've got dedicated email accounts. You're leveraging VPNs. You're keeping your client data effectively, restricted. I mean, I think that's definitely part of the practice, but you also want to make sure that you've got the right kind of nimble tools to still make sure that you've got the level of communication that you need to to service the accounts.
I would add that a good fractional CFO would bring potential data security issues to the table versus having to just adhere to whatever the company policies are. So you're hiring a resource that should be contributing to the solution there, not the problem.
Great. Well, that wraps up our questions. So thank you everyone for joining us.